is R Forex, and I would love to welcome you to this awesome video lesson. I'm so glad you have joined me here today on this video. Now I want to talk to you and show you my strategy, which I call the rocket booster strategy. But before I go on, I would love to thank my mentors, Robert Kiyosaki, who wrote the book Rich Dad Poor Dad, Tim Sykes, who wrote the foreword to the book The Penny Stock Course, and then finally Matthew Greta, who wrote the book Rocket Stocks. So the strategy is actually very easy. The first thing is the price has to be above two EMAs. One, the 50-day EMA. So EMA stands for exponential moving average. Exponential moving average, and it's right here. So I am using something called the MA ribbon. This is an indicator you can find on TradingView. So on the MA ribbon, I changed MA number 1 to EMA, exponential moving average, MA number 2 to EMA, exponential moving average, based on the closing price. You can do it based on the low or on the high, but I put it based on the closing price, 50-day moving average, and then you can change the colors. Ideally green. This is the one I use back in the day. I used to use green a lot back in the day, but even blue works just as well. And then you can change the color to red as well. And so the price has to be above both exponential moving averages, which is the 50-day moving average, and the 200-day moving average. Now the 50-day moving average in this case is represented by this blue line here, and then the 200-day moving average in this case is represented by this red line over here. The next thing you need to pay attention to is something called the parabolic SAR. The parabolic S parabolic S used for placing this. SAR in stock. SAR parabolic method devised by J. Wilder Jr. to find potential reversals in the market price direction of traded goods such as securities or currency exchanges such as Forex. It is a trend following lagging indicator and may be used to set a trailing stop loss or determine entry or exit points based on prices tending to stay within a parabolic curve. So it is the trailing stop loss. Alright, so that's what we are using here. So and it's very very common in the forex trading industry. Excuse me. So we have the parabolic SAR. So the parabolic is calculated almost independently for each trend in the price. When the price is in an uptrend, the SAR emerges below the price and converges upwards towards it. So basically what they're saying is this dot here, to know whether a price is in an uptrend or not, this dot right here goes below the price. Alright, and then it follows the price in an uptrend, showing you that it is a reversal. So this is called a trailing stop reversal. Okay. A modern study of parabolic SAR based on 2,800 years of backtesting over a 12-year period to 2023 on the Dow Jones Industrial 30 stocks demonstrated using the parabolic SAR with a standard OHLC chart resulted in a 19% win rate. Using the parabolic SAR with Hakeshi Ashi chart produced a 63% success rate. Okay, so open, high, low, close chart. Okay, it's a type of chart used in technical analysis to illustrate movement of price in financial instruments over time. So basically, if you use the parabolic SAR on this type of a chart, you are most likely going to get a 20% win rate. But if you use a chart like this, you're going to get a 63% success rate. Where's the Hakeshi? This one. Alright, so if you use a chart, so basically these charts are based on the opening and closing prices. Alright, so that's the formula. So in this case, because our moving averages are based on the closing price, all right, it's based on the closing price, and this candlestick chart pattern is based on the closing price. The Hakashi is based, I believe, I could be wrong, on the opening price. And then they're saying if you base the parabolic SAR on the opening price, like this chart here, you are likely going to get 63% win rate. So so far, like this one here, I based it on the same chart, and it looks like it's doing very very well. I think I recorded a video about 2 days ago or a day ago explaining the strategy. So that's the second part of the strategy. Now I also found these other two stocks as well, this one here and this one here, and I'm yet to see if it will work in the stock market. But one thing for sure, the strategy works very well in commodities market. It's working very well in the crypto market as well, because even in gold I used the same strategy in gold. This is the same strategy we used in gold. It's the same strategy. I'm trying to add gold to the watch list. see. Anyway, hopefully it will appear here. All right, there we go. So it's the same. So this strategy worked in the gold market. It works very well in the forex market, and it works super well in the crypto market. The last step is called the gap. Now, the gap is based upon percentage, based upon price performance. So the gap, I'm just doing a Wikipedia screen. I'm on the site. Presented by an empty area. In this case, what I believe. Especially the shorter one. Not sure. Okay. So they're very may not show if it, okay, it may not show, especially if it gets filled. Okay, gaps commonly occur as trading resumes following an extended period of closing time. For example, as forex trading resumes on Sundays at 5 p.m. following a 48-hour close, and traders take into account the events that may have happened during the weekend. The price gap may be seen on the chart at market open. Price gaps can be a gap up or a gap down. Although the names include the terms up and down, there's nothing to do with expected price action that follows the gap. For example, a gap up can be the beginning of a new uptrend, a continuation of an existing uptrend, or an exhaustion of an existing trend and the beginning of a steep decline. Alright, so basically there are two types of gaps. So this is the last system. The last system is the price. It has to gap up. So basically I'm just that we did, and in asset prices. Now this is, yeah, that's the assets chart on. All right. Uh, the beginning of a new trend. The exhaustion gaps occur near the end of price patterns and signal a final attempt to hit new highs or lows. And these common gaps can't be placed in a price pattern. They simply represent an area where the price has gapped. And then continuation gaps, also known as a runaway gap, they occur in the middle of the price pattern and signal a rush of buyers and sellers who share a common belief in underlying stock future direction. Okay. So I don't know why we're using the 1 hour chart. This is crazy to me. I think the perfect example that I have is gold. So the thing about gaps is they happen so fast, and they are very hard to see. Uh, Price gaps are very hard to see. So let's go through it now. Like I told you, the system is basically involves number one, the exponential moving average, which includes the 50-day moving average and 200-day moving average, where the price has to be above both moving averages. Then number two, well, including the parabolic SAR. So SAR stands for stop and reversal, if I'm not mistaken. Let me see. Stop and reversal, right? It should be stop and reverse. It should be stop and reverse. Let me just confirm that. SAR should stand for and I'm It's basically stop, stop, parabolic stop, and reversal. Okay, and the yes, this is a method. So it's used for finding. It's called stop and reverse. It's used for finding reversals in the market prices. Okay, the parabolic system. And then finally we look at gaps. Now let's jump into the trading screener. So we'll start with the stock screener. Now based on the stock screener, as you can see, the price is above the 50-day moving average. Now you can do a manual. You see, you can do a manual thing right here. So yeah, so basically that's it right there. So price has to be above the 50-day moving average. So the 50-day moving average should be below price. 200-day moving average should be below the 50-day moving average. The gap should be above 0%, which is a common gap, and then the parabolic should cross down the price. And then we have two indexes here, which is S&P 500, and these are the two chart patterns here. So immediately when it happens, ideally during the market open, you're supposed to enter the trade. So in this case, I would not buy these because the gap has already happened, right? So buying it after the gap has happened is not a good strategy. So you want to enter when the market is open, when the gap happens. An example is here. As soon as the gap happens, that's when you want to enter, right there at the market open. Exactly what we did for gold, and exactly what we have done for Forex. Now the Forex one and the Tron one, let me show you where it happened. It happened in the perpetual contract. Hope I didn't delete that perpetual contract. Oh no, I think I deleted it. I'm sorry. Okay, there it is. So in the Tron market, it happened in the perpetual contract. So you want it right there, okay, when the gap actually happens at the market open. So the strategy has to be executed immediately it happens. Immediately the gap happens, you execute the trade, and then it forms a pattern called the three soldiers. So, and from what I am observing, it's more of like, because after the third soldier, there's what you call what? Consolidation. called the three. So I'm going to read about the three white soldiers. Key PD pattern. It unfolds across three trading sessions and represents a strong price reversal from a bear market to a bull market. The price consists of three long candlesticks that trend upwards like a staircase. Each should open above the previous day's open, ideally in the middle price range of that previous day. Each candlestick should also close progressively upward to establish a new near-term high. The three white soldiers help to confirm that the bear market has ended and market sentiment has turned positive. In candlestick charting explained technical analysis, George L. Morris says this type of price action is very bullish and should never be ignored. This candlestick pattern has the opposite, known the three black crows, which share the same attributes in reverse. So basically it is a candle, a complex candlestick pattern. So it is very very important to know about the three white soldiers. It's a very complex candlestick pattern. So basically, according to Steve Newson's book, after the third candle, there's always a consolidation. Okay. Usually after the third candle, there's always a consolidation. But you can see that in the perpetual market, usually that's what happens, right? After the third candle, so it's a continuation, right? So in this case, this could be the first or the second, right? But I think this was the third because there was a consolidation right after. Okay, we can also look at another example. So this was the third because there was a consolidation after. So after the third candle, there is always a consolidation. This was the second candle. So after the third candle, there is always a consolidation. It's just that these two are not perfect because I saw the signal in the perpetual market. They're not. I think they're not perfect in terms of price action, but I would assume in this case this could be the second candle. I would assume that's the second candle in the reversal, right? And so is this one, which I assume is the second candle as well. But the perfect one is obviously this one here, which is the perfect example, showing you the second candle. Then in the third candle, there is always a reversal. So in this case, that's why I would not trade it during the market close, because at market close, let me see. I don't know if we can. we can adjust it to market close. Here. So it has to be during market open ideally. So the ETF market and the stock market, we will have to discount this strategy. The only way we can account for this strategy is during the crypto markets, because the crypto markets are always open, and in this case they're closed. Or not, they're closed, there is no trade. Now the place where I think there is a one screener where I do not use the common gap, and usually in that screener, I think that's a decentralized exchange screener. I do this on purpose because I just want to see what the market makers are looking for. So I purposely remove the gap. We don't need to. So in this case, maybe you can just join me as I remove the unnecessary indicators, just to clean up my screener. So basically that's how it is. Just cleaning up my screener here. So that's the strategy. Okay, so let's see if I can clean up the screener. So ideally this new screener has worked magic wonders for me. The new screener by TradingView has really helped me. And finding this strategy, I wish I could say it was by accident, but it was like crazy hours of studying. And I'll never forget the walk that I took. I took a specific walk, and in that walk, I told myself, I thought about you, who's watching this video. I thought about you, and I asked myself, how can I help this person? How can I help you? And I made a conscious decision. I said, I am going to show you everything. Like, I am not going to hold anything back. Like, I'm going to show you all the secrets. Like, I'm going to show you all the secrets, and I'm just going to break it down. Unfortunately, not everyone will understand the secret, but I just told myself, look, I'm going to show you all the secrets. So let's just clean it up. Because want to make it clean. Okay, clean that one up as well. So basically, this is the parabolic trading system. Basically, that's what we are using. So I would not trade these. These are just examples of what would have happened, or the type of trade that we would have made if we had used the strategy. So let's just keep watching, the trades that we made, like this one that we made today, and we can watch it. Okay, Bitcoin is doing very well. We had a reversal like 3 days ago, and it's doing very, very well. And I think Ethereum has hit a reversal. Let's see. It seems Ethereum is very good for deep buying, and there's no accumulation indicator for Ethereum. Seems it's only good for I can't see the last dip buy. The Ethereum rise is going to be very, 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 very interesting. Because Ethereum has hit a reversal now. And I came up with a funny theory. I think in the last video, I came up with a very funny theory where I was looking for percentage gains. And then I was trading on the 30-minute candle. Me, that was very crazy. What do we have? Testing. you know, when I so okay, let me just close the secret. I know that. The, bye bye and